So this is process of accounting. So in this session, we will be learning about step 2 of process of accounting, that is applying debit credit rules. Now, when you say applying debit credit rules, it has two approaches. One is accounting equation based on dual concept, and second, golden rules of accounting. Now, one thing that is important to remember is, irrespective of whatever approach is followed, the final journal entry will be same. Now, in this session, we will be learning about accounting equation based on dual concept. In this session, we will be learning about what is a dual concept, what is a accounting equation, what is a balance sheet, example of accounting equation and balance sheet, how to derive debit credit rules using accounting equation. Let's begin. Dual aspect concept or accounting equation. So every transaction has a twofold effect and so should be recorded in two places in the books of accounts. At least two ledger accounts will be involved in one transaction. Assets is equal to liabilities plus capital. So as per the dual concept, every transaction will at least have effects in the two ledger accounts, and at least two ledger accounts will be involved in one transaction, because the dual concept says that whenever there is a change in any asset, there has to be a change in the liabilities and the capital. Now, assets are resources of the firm and liabilities plus capital are the sources of the funds. So, at any point of time, your assets should be equal to liabilities plus capital. Now, this equation is known as accounting equation. Let's see one example. This is a business of Mr. A. Now, Mr. A has introduced a capital of rupees 1 lakh. He has also taken a bank loan from PQR Bank of rupees 2 lakhs. So, total sources of funds is 3 lakhs. Now, this 3 lakhs is utilized for the purpose of business. Say, Mr. A purchases some furniture for rupees 50,000. He purchases some machinery for rupees 1 lakh, and then the balance amount is kept in the bank. So, what is the balance amount? Now, sources of funds were 3 lakhs. Total expenditure till now is 50,000 plus 1 lakh. So, balance is 1 lakh 50,000. So, these are your resources or assets. 50,000 plus 1 lakh for machinery and balance 1 lakh 50,000 in the bank account. These are assets or resources. So, at any given point of time, your assets should be equal to liabilities plus capital. This is an accounting equation. Now, accounting equation states fundamental relationship among different components of the balance sheet. So, in balance sheet, while preparing a balance sheet of an entity, we represent their assets, liabilities and capital. Therefore, the accounting equation is also known as a balance sheet, and balance sheet is always prepared as on the particular date or as at a particular date. So, at a given point of time in a particular day, we can prepare balance sheet wherein we will present the assets, liabilities and capital, and the total of assets should be equal to liabilities plus capital. So accounting equation is also known as a balance sheet. Now assets, as explained earlier, it reflects what entity owns, whereas liabilities plus capital will represent what entity owes either to the owner, that is in case of capital, or to the outsider, that will be in the case of liabilities. Now let's see this equation in detail. Assets is equal to liabilities plus capital. Now assets can be further divided into two types, that is fixed assets and current assets. Liabilities can be your long-term liabilities or current liabilities, also known as short-term liabilities. Capital will be your contribution from the owner. Now, this fixed assets can be further expanded into land and building plus furniture and fixtures plus plant and machinery plus goodwill, etc. This all comprises of your fixed asset. Plus, your current assets can be further bifurcated into your debtors, or also known as accounts receivable, plus bills receivable, plus cash or your bank balance, plus prepaid expenses, plus stock. So this comprises of your current asset is equal to your long-term liabilities. Now long-term liabilities may be a bank loan plus loan from any other entity plus current liabilities. Now, current liabilities comprises of your creditors plus bills payable plus outstanding expenses, etc. plus capital. Now capital can be bifurcated as your opening balance of capital, that is balance of the capital which was there beginning of the period or the beginning of the year, plus any additions in the capital if the owner has introduced any new capital, less drawings plus profit minus loss. This represents your capital. Now this plus profit minus loss. Now profit is nothing but your income minus expense. And when your expense is greater than income, it is expense minus income. It is loss. So instead of profit minus loss, we can also record it as income minus expense. Now let's see one example of accounting equation. Mr. Mohan started a business of trading in mixers and grinders on 1st Jan 2019. On 1st Jan 2019, Mr. Mohan introduced a capital by depositing rupees 3 lakhs in the bank account of the business. So Mr. Mohan has started a business of mixers and grinders, and on 1st Jan 2019 he has introduced a capital by depositing rupees 3 lakhs in the bank. Now since Mr. Mohan has introduced a capital, your capital will increase by rupees 3 lakhs. That is, there is an increase in liability. Since he has deposited this amount in the bank, your bank account, business bank account balance will increase by 3 lakhs. So there is an increase in asset. Now let's adjust this transaction in the balance sheet. Now this is a format of the balance sheet. You have liabilities on the left hand side. This is an internal amount column for any adjustment, and this is a outer amount column for your final amount. Similarly for assets, amount. On the liability side, we'll write Mr. Mohan's capital account 3 lakhs, and on the asset side, bank balance 3 lakhs. Total of liabilities is 3 lakhs. Total of assets is 3 lakhs. Now let's go to the next transaction. But before moving on to the next transaction, let us understand that this balance sheet is as on 1st Jan 2019. Now, whenever there is a next transaction, we have to carry forward this balance sheet as it is and then make the adjustments of next transaction in the balance sheet. That means the balance sheet is prepared as at the particular point. So each financial transaction will have an impact on balance sheet. Now let's go to the next transaction. 1st Jan 2019, Mr. Mohan also brought in cash of rupees 2 lakhs. So he has introduced a capital in the form of cash of rupees 2 lakhs. So there is an increase in capital by rupees 2 lakhs. That is increase in liability, and there is increase in cash balance since he has introduced a cash rupees 2 lakh. So cash is an asset, so increase in asset. Now let's give effect of this transaction in the balance sheet. Now this is a balance sheet which has been carried forward from the last transaction. So capital, initially he had introduced 3 lakhs in bank, now plus cash brought in 2 lakhs. So total capital becomes 5 lakhs. On the asset side, there is an increase in cash balance 2 lakhs. Total of liabilities side is 5 lakhs. Total of asset side is 5 lakhs. Now let's move on to the next transaction. On 1st Jan 2019, he also brought a tempo worth rupees 6 lakhs from his personal account for the purpose of business. So, Mr. Mohan has purchased a tempo worth rupees 6 lakhs and he has paid it from his personal account. So, indirectly, he has introduced a tempo as a capital. So instead of depositing 6 lakhs in his bank account and then withdrawing it for the purpose of purchasing tempo, he has directly paid it from his personal account. So what has happened here? Capital has increased since he has invested rupees 6 lakh in an asset. That is increase in liability, and your tempo, there is an additional asset, vehicle. It's an increase of 6 lakhs. Now let's see impact of this transaction on the balance sheet. So this is a balance sheet, add purchase of tempo. How much? 6 lakhs. So that comes to 11 lakhs. And there is an additional asset. So on the asset side, tempo, vehicle. This is a fixed asset, 6 lakh. So total of liability side is 11 lakh. Total of asset side is 11 lakh. Now let's move on to the next transaction. On 2nd Jan 2019, bought a furniture, tables and chairs for rupees 75,000 from Messrs. PQR Limited and paid rupees 25,000 on same day by check. Balance will be paid later. So 75,000 is the furniture, amount of the furniture which has been bought. Out of that, 25,000 is paid by check and balance 50,000, that is 75,000 minus 25,000, will be paid later. So what are the transactions here? There is a purchase of furniture, so increase in asset, that is furniture. So what is the value of furniture? Furniture of rupees 75,000. Rupees 75,000. Now 25,000 is paid by check. So there is a decrease in bank balance. That means decrease in asset. What asset? Bank balance by 25,000. This 50,000 will be paid later to Mrs. PQR Limited. That means we are obliged to pay Messrs. PQR Limited amount of 50,000. So there is a liability, increase in liability. Messrs. PQR is our creditor for furniture. 50,000. So now let's see the impact of this transaction on the balance sheet. First is increase in asset, furniture 75,000. So there is an increase in fixed asset. So furniture 75,000. Decrease in asset, that is bank balance, less paid to PQR Limited. How much is the amount? 25,000. So that makes it 2,75,000. And then increase in liability, Messrs. PQR. So we have to record a new liability payable to Messrs. PQR 50,000. So in liability side, QR Limited, we'll write it as creditor for furniture. He is not creditor for your ordinary goods. He is creditor for purchase of asset. Amount will be 50,000. And in this transaction, there is no impact on capital. So capital will remain as it is. So liability side total is 11,50,000. Asset side total is 11,50,000. So now let's move on to the next transaction. 4th Jan 2019, signed an rent agreement for office premises with Miss Nikhila and paid rupees 1 lakh by check as deposit. It will be returned at the time of vacating the premises. So there is some premises which is taken for rent, and for this a deposit of 1 lakh is paid to Miss Nikhila. Now this deposit will be returned at the time of vacating this premises. So that means Miss Nikhila owes us 1 lakh rupees which we have paid her now at the time of vacating the premises. So this deposit with Miss Nikhila will receive it back at the time of vacating the premises. So it's an asset. So there is a increase in asset and it's paid to her by check. So there is a decrease in our bank balance since we have paid it by check of rupees 1 lakh. So decrease in asset of 1 lakh. Now let's see the impact of this transaction on balance sheet. So this is a balance sheet. Now from deposit with Miss Nikhila rupees 1 lakh. We have to record it in asset. Nikhila. 1 lakh, and since we have paid by check, let's pay to Nikhila 1 lakh. So balance that is carried to outer column is 1,75,000. Now there is no impact on capital, so capital is same in the outer column. So liability side total is 11,50,000 and asset side total is 11,50,000. Now let's move on to the next transaction. 4 Jan 2019. As per the agreement, rent for the month is due and to be paid at the beginning of the month. Rent is rupees 10,000 per month. Paid rent of rupees 10,000 to Miss Nikhila in cash. So in last transaction we had seen that we had taken the office premises from Miss Nikhila and rent of 10,000 is paid to Miss Nikhila in cash. So now this rent of rupees 10,000 is a expense. Okay, and since it is paid in cash, cash is a asset. So there is a decrease in asset since it is paid in cash. Now for this expense, if you see as explained earlier, your capital is equal to opening balance of the capital plus any additions less drawings plus your profit minus loss. Now this profit and loss can also be written as plus your income minus expense. So since the rent is an expense, it will reduce your capital. That is, it will decrease your liability. So the impact of this rent paid will reduce a capital or reduce our liabilities. Now let's see how to adjust this transaction in the balance sheet. Rent of rupees 10,000 capital. So less rent to Nikhila 10,000. So your capital balance comes to 10,90,000. And since it is paid by cash, there is a reduction in asset. We will reduce it from cash balance. Paid to Nikhila 10,000. So this is 1,90,000. Now total of your liability side is 11,40,000. Total of asset side is 11,40,000. Now let's move on to the next transaction. 8 Jan 2019. Took a loan of rupees 3 lakh from ABC Bank. Bank has given a check. Now Mr. Mohan has taken a loan of rupees 3 lakhs from ABC Bank. So there is an increase in liability by rupees 3 lakhs. Since the loan taken from ABC Bank is a liability. The bank has given a check. So we will deposit it in our bank account. So there will be increase in a bank balance. So that is increase in asset by rupees 3 lakhs. So let's see the impact of this in our balance sheet. Increase in liability, that is loan from ABC Bank of rupees 3 lakhs. On liability side, loan from ABC Bank 3 lakhs. And there is a increase in the asset, that is increase in the bank balance. So add check received or deposited in the bank, that is 3 lakhs. So your bank balance will be 4,75,000. So the total of your liability side is 14 lakh 40,000, and total of your assets is 14 lakh 40,000. Now the next transaction. 15 Jan 2019. Goods purchased from Mr. Shalimar Traders. Details of goods purchased are: purchased 10 mixers at rupees 3,500 each. The mixers are purchased on credit of 2 months. Now there are goods purchased. So how much is the worth of goods? Is 10 mixers into 3,500 each, that is 35,000. Now this 35,000, since it's a purchase of mixer, it will increase your stock of goods by 35,000. So this stock of goods means increase in the asset. Now these mixers are purchased on credit of 2 months. So after 2 months, Mohan is obliged to pay Messrs. Shalimar Traders rupees 35,000 for the mixers. So since we are obliged to pay, in the books it will be our liability, or we can also call it as a creditors. So 35,000. So increase in liability 35,000. Now let's adjust this in the balance sheet. So increase in the stock of good. So on asset side, stock 35,000. On liability side, we'll write it as Messrs. Shalimar Traders. They are creditors. 35,000. Total of the liability side is 14,75,000. Total of the assets is 14,75,000. Now let's move on to the next transaction. 17 Jan 2019. Sold 2 mixers to Mr. Amok for 5,000 each, and Mr. Amok paid immediately in cash. So sold 2 mixers. So 5,000 each mixer into 2 is 10,000. So now this sale will have 3 impacts. Okay. Now these 2 mixers are sold for rupees 10,000. So there will be a decrease in stock of goods. So how much? By 2. So what was the cost of this mixers? See, stock is 10 mixers at 3,500 each. So 3,500, that comes to 7,000. So there will be decrease in the stock of goods by 7,000. Then we have received a cash immediately. So there will be increase in cash balance. How much is the cash received? 10,000. So cash balance will increase by 10,000. Now if you see, the cost of mixers was 3,500. We have sold it for 5,000. So we have made a profit. So what is a profit? Profit is your mixer worth rupees 7,000 are sold for 10,000. So 10,000 minus 7,000. So profit is how much? 3,000. Now since this is a profit, it will be added to your capital account. And there will be an increase in liability. Now let's see the impact of this transaction on the balance sheet. First, stock of goods have reduced by 7,000. So less goods sold, 7,000. So stock is 28,000. Your cash balance has increased by 10,000. So add amount received on sale of goods, that is 10,000. Now your cash balance is 2 lakhs. Then profit. of 3,000. So we have to add profit 3,000. 10,93,000. So your total of liabilities is 14,78,000, and asset side also 14,78,000. Now let's move on to next transaction. 22nd Jan 2019. Sold 5 mixers to Messrs. Devi for rupees 5,000 each on credit basis. Credit period is 1 month. So now this 5 mixers are sold for rupees 5,000. So amount is 25,000 on credit basis. So and credit period is 1 month. That is Mrs. Devi will pay us after 1 month. Now this transaction will have 3 impacts. Now since there is a sale of mixer, the stock of mixers will reduce. Now what is the cost of the stock? We had 8 mixers at rupees 3,500 each. So stock will reduce by 3,500 into 5 mixers, 17,500. Now we have been selling it for a credit. So Messrs. Devi is obliged to pay us after 1 month. So Messrs. Devi is our debtor. So there is an increase in asset. By how much? By 5 mixer into 5,000. That is 25,000. Now there is a profit. How much is a profit? The sale price of the mixer is 25,000 and the cost of the mixers are 17,500. So there is a profit of 7,500. So this profit will increase our capital balance. So there will be increase in the liability. Now let's see the impact of this transaction on the balance sheet. On the first is decrease in stock by 17,500. So in stock, goods sold 17,500. So in the outer column 10,500. Then there is an increase in asset. Mrs. Devi, debtor. So Mrs. Devi, debtor. By how much? By 25,000. Then there is a profit of 7,500. So there is an increase in the capital. Add profit on sale of goods. This 7,500. So total is 11,500,000. Total of the liability side is 14,85,500 and total of asset side 14,85,500. So this was an example on how to prepare a accounting equation, and from this example we understand that each and every financial transaction will change your accounting equation or will change your balance sheet. Now let's summarize this. Now this is an equation which we had seen it. Fixed assets plus current assets is equal to long-term liabilities plus current liabilities plus capital. Now let's understand how to derive a debit credit rule using this equation. Now this capital, as said earlier, is opening balance plus your additions minus any drawings or withdrawals plus your profit minus your losses. Now this profit and losses can also be written as plus your income minus your expenses. So this is a bifurcation of capital. Now let's rewrite this equation by taking all the negative entries, that is drawing, losses and expenses on the other side. Let's rewrite it. So it will be your fixed assets plus current assets. Now since we are taking this drawings, losses and expenses on the other side, there will become positive plus drawings plus losses plus expenses is equal to, on this side you have long-term liabilities plus current liability. So long-term liabilities plus current liabilities plus your capital. Now capital will be having your opening balance plus your additions to opening balance plus your profit plus your income. So let's summarize this equation now. Your fixed assets plus current assets can be summarized as assets plus drawings plus losses plus expenses is equal to, now this long-term liability and short-term liability can be summarized as liabilities plus opening balance and additions to capital. We can write it as capital plus your profit plus income. Now this is how we rewrite this equation. So now to summarize and to understand a debit credit concept, now assets, drawings, losses and expenses. Whenever there is an increase in asset, drawing, losses and expenses, we have to debit. And whenever there is a decrease, we have to credit. Now for liabilities, it's opposite. That is liabilities, capital, profit and income. So whenever there is an increase in liability, capital, profit and income, we have to credit. Whenever there is a decrease in liability, capital, profit or income, we have to debit. So this is how we will be posting a debit credit entries in our books of accounts, and using this accounting equation and rewriting it, we have derived a debit credit rules. So for this side of accounting equation, this is a rule. For assets, drawings, losses and expenses, increase will be debited, decrease will be credited. Whereas for the liability, capital, profit and income, increase will be credited and decrease will be debited. Now let's prepare a summary statement for this. This is a summary. So for asset, drawing, losses and expenses, whenever there is an increase, we have to debit, decrease, we have to credit, and vice versa for liabilities, capital, income and profit. Whenever there is an increase, we have to credit, and whenever there is a decrease, we have to debit. So this was about accounting equation and how we derive debit and credit rules using accounting equation. Hello everyone. Vanijya Vidya launches its educational site vanijyavidya.com. It comprises of courses related to accountancy and finance. Courses are aligned to specific academic syllabus and practical industry needs. 2 courses are live now. Courses comprise of virtual whiteboarding video tutorials with in-course knowledge checks followed by do-it-yourself quizzes and exercises. Course page contains details of the course, your instructor details, class curriculum and course preview. For more information and update, enroll to vanijyavidya.com. Thank you.